Hello, everybody. My name is Lush Eisner, and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. Please like and subscribe. I record 2 videos per week, so make sure you ring the notification bell to get notified each time one comes out. This is my thoughts on market happenings for the week ending June 9th, 2023. Looking at the market indexes for the week, the TSX was down, but the S&P 500, Nasdaq, Dow Jones, and Russell 2000 were all up. Gold was up, oil was down to around $70 per barrel for the week. Turning to Canada, the Bank of Canada raised interest rates by 0.25% on Wednesday to 4.75% after two pauses. They cited Canada's economy being stronger than expected in the first quarter of 2023, with GDP growth of 3.1%. Consumption growth was surprisingly strong and broad-based. CPI inflation ticked up in April to 4.4%, and which was the first increase in 10 months, with prices of a broad range of goods and services coming in higher than expected. Goods price inflation increased despite lower energy costs. Service price inflation remained elevated, reflecting strong demand and a tight labor market. The bank is also continuing quantitative tightening, not buying Government of Canada bonds and or letting them expire and letting the fixed interest rates drift up also. The markets didn't mind the announcement going up initially and then ending the day down 1/3%. There are suggestions that more Canadian rate hikes are coming, with the word, quote, resolute being used in the central bank statement regarding bringing down inflation, while the market is thinking that there was to be a rate hike. The bank statement would be more reconciliatory and dovish towards no further hikes. Instead, we got a hawkish raise. The 0.25% is a small raise compared to the large hikes we've had last year, but it is significant psychologically because the markets, real estate and stock markets, though the hikes were done, and if anything, there would be cuts, and those hopes are now gone. You might see buyers pull out of real estate markets, wanting to wait for the rates to come off and increase the demand for rentals in the meantime. I don't believe there will be cuts unless we get into a serious recession or the inflation comes off significantly. All other things staying constant, the Canadian dollar will gain some strength on this 0.25% raise, especially if the US Fed doesn't raise next week. The odds of the US hike, though, have increased with Canada's hike. The Bank of Canada sees a 0 to 1% real interest rate as the neutral interest rate. And we are in this range right now, by the way, since we're at 4.75% less the 4.4% inflation. This week, we also had the Canadian unemployment rate ticking up 5.2% from 5.0, worse than expected on Friday. More Canadians are missing loan payments and getting deeper into debt, according to an Equifax report. Total Canadian consumer debt was up almost 5% year over year in Q1, pushed by an increase in credit card usage, with a 14.5% year over year jump in credit card balances and a 21.5% increase in spend per credit card holder versus pre-pandemic. Missed payments on non-mortgage products are also up 19% year over year for Q1. Bankruptcies have been flat, but consumer proposals are above pre-pandemic levels. Credit demand was high in the first quarter of the year, while the mortgage market saw significant slowdowns. There is a trend on both sides of the border for money to move out of stocks and out of bank savings accounts and into money market funds, where that money is getting 4% returns. There is now an alternative, including corporate bonds, which pay a real return and have narrowed the gap between these interest payments and dividends from stocks. This is bad for stocks since their prices come down, all other things equal, and the banks have less deposits, therefore able to lend less and making lower profits. And of course, after the small bank crisis and stock volatility, a risk-free return is a good return. Turning to the United States, the U.S. jobs report from last week showed the U.S. unemployment rate jumped from 3.4% to 3.7, higher than expected, and included a moderation in wage inflation, lowering fears of further rate hikes in the U.S. Initial weekly jobless claims came in at 261,000 on Thursday, a 19-month high, higher than the 235,000 expected and 233,000 for the previous read. This is making the odds of a US rate hike next week lower. Amazon might be planning to offer Prime subscribers a pretty significant perk, free cell phone service. The company is talking with multiple US-based carriers about offering cheap, around $10 a month, or even free phone service to Prime customers. Right now, Amazon is supposedly negotiating with 3 major US carriers, Verizon, AT&T, and T-Mobile, as well as the Dish Network. The US mobile carriers' share went down on the news. The likelihood of it coming to Canada seems low because our carriers seem reluctant to partner. Even though General Motors and its main rivals are pushing toward an all-electric future, they're still heavily reliant on good old-fashioned pickup trucks powered by gas and diesel. The company underlined that fact Monday when it announced it would invest $1 billion to manufacture new heavy-duty pickups in Flint, Michigan. GM is counting on its highly profitable pickups to carry it financially into an era where it can churn profits on electric vehicles. Speaking of General Motors, it is the latest legacy automaker to partner with EV leader Tesla to utilize its supercharger network. Under the agreement, which very closely resembles a partnership struck last month between Tesla and Ford, GM owners will have access to 12,000 Tesla superchargers across the country starting next year. GM will also begin building Tesla's charging tech into its EVs starting in 2025. The pair of partnerships is a massive step towards a unified charging standard for US electric vehicles. All 3 CEOs, GM's Mary Barra, Ford's Jim Farley, and Tesla's Elon Musk, have spoken out in support of streamlining charging infrastructure to advance the mass adoption of EVs in the US. The US banks will be less aggressive in extending credit under the new rules from the US Fed, which include a 20% capital requirements or bank reserve ratio limit, where they can only lend out 80% of their deposits and having to keep the other 20%. During COVID, the US government allowed zero reserve limit, trying to keep money flowing, and the capital requirement has stayed at zero during this time. The industry will have some years to come to this capital requirement via lesser loans while still accepting deposits, and those deposits would go directly to the capital requirements. Internal earnings would also be kept as capital requirements. The US has been barreling toward a recession, or maybe standing at the cliff, or maybe already on the decline for months now, depending on who you ask. But ask the American consumer, and by some definitions, all is well. New home sales, leisure travel, and job growth have remained bright spots in an otherwise shaky economy, helping to stave off a more significant reset. Quote, the US and global expansion stand on solid ground, and fears of an imminent recession look overblown. End quote. Marko Kolanovic, global market strategist at JP Morgan, said in a note to clients this week. The S&P 500's longest bear market since the 1940s has come to an end. The benchmark index closed up 0.6% to 4,294 on Thursday, vaulting it back into bull territory with a 20% advance from its October low. This is on the back of very few companies in the index. The S&P 500 index has gained 9.7% in 2023 as of May 31st, but most of that has been due to the surging prices of a few of the largest companies. These companies are mainly in the tech and AI sectors, and they have benefited from strong earnings, innovation, and market optimism. The 7 stocks that have driven the most growth in the S&P 500 so far this year are Apple, Microsoft, Nvidia, Meta, Amazon, Tesla, and Alphabet. These 7 stocks account for almost 90% of the S&P 500's gains in 2023, while the rest of the index has been modest or negative. This narrow market is a risk because of these stocks. If they falter, the market won't touch the sides on the way down. Now for some bits and pieces. The results of the OPEC meeting are in from last weekend, and Saudi Arabia has voluntarily cut 1 million barrels per day starting next month, and this is on top of the 500,000 barrels cut per day in April in an effort to get the oil prices to an $80 to $100 range. The voluntary cuts come after a meeting of OPEC Plus partners in which the group of global petroleum exporters maintained earlier production plans for the rest of the year. International benchmark Brent crude futures traded about 1.6% higher Monday morning, while US West Texas intermediate futures were about 1.7% higher. But oil came back down again fairly quickly, probably because the OPEC members frequently cheat at their production and because Russia wasn't at the meeting. Saudi Arabia is the world's top exporter of oil. The OPEC group of countries accounts for about 40% of the world's crude. It is likely that OPEC wants the oil price in the $80 to $100 range so as to make hefty profits, but so as not to encourage the world's energy transition away from oil with high prices. China is looking like it is still in a slowdown from COVID or otherwise. Disappointing inflation data bolstered bets that Beijing will roll out more stimulus measures this year to shore up growth. Official data on Friday showed that Chinese consumer inflation fell in May from the prior month, while the country's factory gate prices shrank at the fastest pace in 7 years. There is stimulus policy expected from the Chinese government trying to increase consumption. Finally, turning to next week, we have a few companies reporting next week. On Monday is Oracle, Wednesday is Lennar for a look at the US real estate market, and Thursday is Adobe. A couple of economic events next week. On Tuesday, we have the US CPI read for inflation, just in time for Wednesdays when the US Central Bank is announcing its interest rate decision, with staying pat being the likeliest. If you have any requests on what you would like me to cover in future videos, please put that into the comment section. If you'd like to get in touch, please reach out on any of these social media channels, and may you have a profitable day.